Hello everyone, welcome to another video. Hope everyone is enjoying their weekend. It is Saturday, the 30th of September 2017, meaning that tax season is just around the corner. Now we have started to receive more and more questions on taxes as they relate to Bitcoin and cryptocurrencies, and that's what has prompted this video. What we're going to outline for you is what constitutes a taxable event, what constitutes a non-taxable event, and how you can ensure that you are IRS compliant when it comes time to file your taxes. So without further ado, let's go ahead and get into it. We'll start off by reading this notice 2014-21. This is from irs.gov, and here we go. So the IRS is aware that virtual currency may be used to pay for goods and services or held for investment. Virtual currency is a digital representation of value that functions as a medium of exchange, a unit of account, and or a store of value. So that's pretty interesting. I mean, there are a lot of people out there that say Bitcoin is absolutely 100% not a store of value. It can't be. It's too volatile. It can't be relied upon to maintain a steady price, blah, blah, blah. Peter Schiff comes to mind when I think of that. He insists that Bitcoin is simply not a store of value and that you need to be investing in gold instead. But here we have the IRS defining cryptocurrency, Bitcoin, as a store of value. So I thought that was pretty interesting. Let's read on. In some environments, it operates like real currency and is customarily used and accepted as a medium of exchange in the country of issuance, but it does not have legal tender status in any jurisdiction. That's important. Make sure you take note of that. In the eyes of the IRS, Bitcoin and cryptocurrency is not legal tender rather. But even though it's not legal tender, they're still going to tax the hell out of it. That's what I don't understand, and that's what blows my mind. I don't know how they can legally tax it without legally recognizing it, but that's exactly what they're doing. Let's proceed. Virtual currency that has an equivalent value in real currency or that acts as a substitute for real currency is referred to as convertible virtual currency. Bitcoin is one example of a convertible virtual currency. It can be digitally traded between users and can be purchased for or exchanged into US dollars, euros, and other real or virtual currencies. And then it gives some references, blah, blah, blah. We're just going to scroll down to the question and answers portion now, which contains a plethora of information. And this is where we start to get into some of the taxable events. So here we go with question number 1. How is virtual currency treated for federal tax purposes? And answer number 1 is, for federal tax purposes, virtual currency is treated as property. That is also very important to note. We'll talk about that more later. For now, let's move on to question number 2. Is virtual currency treated as currency for purposes of determining whether a transaction results in foreign currency gain or loss under U.S. federal tax laws? And the short answer is no. Don't need to get into that anymore, just no, it's not. Question number 3, must a taxpayer who receives virtual currency as payment for goods or services include in computing gross income the fair market value of the virtual currency? And the short answer there is yes. Now, remember I mentioned we were going to talk about taxable events as they pertain to buying and selling using Bitcoin, and this is taxable event number 1. So anytime you exchange your Bitcoin for goods or services is actually a taxable event, because regardless of where you bought that currency at, it has either gained or lost value with relation to the US dollar since then. And now you're not selling it. You're not selling the current currency, but you are using it, and you no longer have it. Therefore, at this moment in time, now you have to compute the cost basis and the value at the time that you spent it and determine how much profit you realized between the purchase date and the date of use. Kind of complicated and very, very annoying. The only way you can even keep track of that is to basically maintain a handwritten ledger of all of your transactions, and that's not even practical, honestly. Very, very annoying, but I guess you gotta do what you gotta do, right? Let's move on. Question number 4. What is the basis of virtual currency received as payment for goods or services? The basis of virtual currency that a taxpayer receives as payment for goods or services is the fair market value of the virtual currency in US dollars as of the date of receipt. So that's why I said you have to make careful note of the day that you purchased the cryptocurrency and the day that you spend it, or the day that you sell it, because that is used in computing the basis of the virtual currency. Question number 5. How is the fair market value of currency determined, of virtual currency determined? And the answer is, for U.S. tax purposes, transactions using virtual currency must be reported in U.S. dollars. Therefore, taxpayers will be required to determine the fair market value of virtual currency in U.S. dollars as of the date of payment or receipt. If a virtual currency is listed on an exchange and the exchange rate is established by market supply and demand, the fair market value of the virtual currency is determined by converting the virtual currency into U.S. dollars at the exchange rate in a reasonable manner that is consistently applied. So again, because the IRS does not recognize Bitcoin or digital currencies as legal tender, you always have to convert the value into US dollars in order to determine fair market value. Really, that's all that is saying there. We'll move on to question 6. Does a taxpayer have gain or loss upon an exchange of virtual currency for other property? So this is going to be taxable event number 2, actually. And the answer is yes. If the fair market value of property received in exchange for virtual currency exceeds the taxpayer's adjusted basis of the virtual currency, the taxpayer has taxable gain. So let's break that down. Now, what that means is if you buy some Bitcoin, let's say you paid $4,000 for your Bitcoin, and now you have 10 of them, and you're going to go use that money to buy a car. And the car costs $50,000. Now, since you bought that Bitcoin at $4,000, it has appreciated. Now it's worth $5,000. So you're going to use your 10 Bitcoin worth $50,000 to buy a car that's worth $50,000. And so awesome, you buy your car free and clear. But that transaction represents the realization of a $10,000 profit. So now that profit will be taxable. That's taxable event number 2. Moving on, question number 7. What type of gain or loss does the taxpayer realize on the sale or exchange of virtual currency? And this is going to be taxable event number 3. So if you buy Bitcoin or any other digital currency for the purpose of investing and just watching it grow over time, eventually you're going to have to sell it, right? You're going to have to liquidate it, turn it into US dollars. That is if you use US dollars to purchase it in the first place. And as soon as that happens, this is another taxable event, and you're going to have to compute your gain and then report it at the end of the year. So let's read the answer here. The character of the gain or loss generally depends on whether the virtual currency is a capital asset in the hands of the taxpayer. And it is. Bitcoin is defined by the IRS as a capital asset, so you will have to pay capital gains. A taxpayer generally realizes capital gain or loss on the sale or exchange of virtual currency that is a capital asset in the hands of the taxpayer. So for example, stocks, bonds, or other investment opportunity, or other investment properties, they are generally capital assets, as is Bitcoin, so that's why you pay a lot of the same taxes. Moving on, question number 8. Does a taxpayer who mines virtual currency realize gross income upon receipt of the virtual currency resulting from those activities? The answer, yes. When a taxpayer successfully mines virtual currency, the fair market value of the virtual currency as of the date of receipt is includable in gross income. So that is taxable event number 4. And now we've covered all of the taxable events that I was going to talk about. So in the eyes of the IRS, by you mining Bitcoin or digital currencies and verifying those transactions, you are providing a service. Now for that service, you are compensated with Bitcoin or whatever coin or token. So that is income in the eyes of the IRS, and that is why it is taxable. So there's our 4 taxable events, right? Anytime you receive Bitcoin for goods or services, if you work for an employer who pays you in Bitcoin or some other coin, that is taxable income, reportable at the end of the year, just as any other ordinary income. Number 2, if you exchange Bitcoin for any other property, whether that be, it can be anything. And we're not talking about just real estate property. We're talking about, cars, real estate as well. Anything of value, really. That's what the IRS views as property. Number 3, if you sell your investment, your Bitcoin, For fiat currency, that is going to be a taxable event. You have to compute it and report it at the end of the year. And then mining, you have to pay gains on your mined currency as well, which I think is ludicrous, but it is legally required. Let's go ahead and skip on down here a little bit. Some of these questions are not really, we don't need to cover them. Okay, this is where it starts to get really interesting. Is a payment made using virtual currency subject to information reporting? And here's the answer. A payment made using virtual currency is subject to information reporting to the same extent as any other payment made in property. For example, a person who, in the course of a trade or business, makes a payment of fixed or determinable income using virtual currency with a value of $600 or more to a U.S. non-exempt recipient in a taxable year is required to report the payment to the IRS and the payee. So this is just going back to the taxable event where you are essentially exchanging your Bitcoin for other property, right? If that happens and the value is in excess of $600, then it is reportable. Otherwise, it's not. So they're not worried about small change here. It's called de minimis, right? And actually, here's a pretty interesting. Actually, this is a bill. This is from coincenter.org, and this is a bill that has been proposed pretty recently, and the intent here is to make it federal law that this says that you don't have to pay taxes on Bitcoin transactions as long as those transactions don't exceed $600. And I mean that would be awesome. That would be so good for Bitcoin, and that would make it that would really open the door wide open for Amazon and all these businesses to adopt Bitcoin, because then people are not having to worry about paying taxes on all these transactions. So you can go to Starbucks and buy a coffee, you can go to McDonald's and buy a burger, do all this stuff and not worry about paying taxes on that income. So you can slowly spend your profits and not have to realize the profits as capital gains. So that would be huge. But I'll include the link to this in the video description. But for now, I'll cover some of the main points. So this is a bill to amend the Internal Revenue Code of 1986 to exclude from gross income de minimis gains from certain sales or exchanges of virtual currency and other for other purposes. So that's why I brought this up, because it references the term de minimis gains, and that just means gains that are so small that the IRS is not worried about you calculating them. That's really all that means. Let's see here. So gross income shall not include gain from the sale or exchange of virtual currency for other than cash or cash equivalents. The amount of gain excluded from gross income under subsection A with respect to a sale or exchange shall not exceed $600. So that's saying that if you want to use this sort of loophole, then you need to make sure that your transaction does not exceed $600. Otherwise, you will be responsible for reporting capital gains on that entire transaction. For purposes of this subsection, all sales or exchanges which are part of the same transaction shall be treated as one sale or exchange. So all that means is if you buy an item that's $100 and you buy 7 of them, well, now that entire transaction is taxable because it exceeds the $600 threshold. So you have to be kind of clever with some of your purchases, I suppose, if you want to take advantage of this, if it is actually adopted and made actual law. So there's some more information to be read there. I'm not going to go over all of it, but if you want, I will make sure to include the link in the description, and you guys can check it out. Let's see, is there anything else we need to cover here? Really, the important takeaway of these last few questions is that $600 seems to be the focus of the IRS. So if you're not making transactions in excess of that, then you're going to be able, one of these days here pretty soon, we're going to be able to use our digital currency on a daily basis for buying and selling daily goods and services. As long as it doesn't exceed that $600 threshold, it won't be taxable, and that will be absolutely phenomenal. Now, another threshold I would like to talk about, this kind of relates to that same story, is, all right, here's a story called "The IRS Blinks in Bitcoin Probe, Exempts Coinbase transactions under $20,000." Now I have covered this in one of my other videos. I might throw the link in the description. We'll see, in case everyone wants to go back and watch that. But the IRS was launching this probe into Coinbase, trying to obtain a wealth of information on its users. And I mean, Coinbase rejected the probe. They did not like it. Obviously, it would have had bad implications for their business, and customers wouldn't have liked it either. So what they did is they launched a lawsuit against the IRS, and finally the IRS started backing off. And now they only want information on Coinbase clients who made transactions in excess of $20,000. So that's one thing to keep in mind if you use Coinbase, like probably most everyone in the United States. It is the largest exchange in the U.S., but maybe if you have a lot of money and you're trading it on Coinbase, maybe you want to try to stay under that $20,000 threshold. That'll keep you out of the IRS focus, and maybe, I mean, I'm not saying you should be trying to evade taxes by any means, but it would probably be smart to at least refrain from attracting like the direct eye of the IRS, you know what I mean? But no, you should definitely pay your taxes. That's the whole reason for making this video. Everyone should pay their taxes on cryptocurrency and ensure that you are compliant with the IRS. So you'll have that complete peace of mind. You don't have to worry about one day, years in the future, the IRS comes at you and says, hey, you've been cheating on your taxes, and now we're going to criminally prosecute you. You don't want that to happen. You definitely want to pay your taxes. Let's see what else we have to cover here. All right, let's talk about non-taxable events, right? Really, the only non-taxable events with relation to cryptocurrency is when you keep your money in the crypto space. So if you buy Bitcoin and it goes up in value, and then you use that Bitcoin to buy other altcoins, maybe you think 10x is really going to shoot up in the near term. So you're like, you know what, I can make more money in 10x than I can in Bitcoin. So you go buy some 10x, and then it does. It goes up in value. Maybe you double your money. You're all excited, right? That's fine. You don't have to pay taxes on that immediately. You only have to pay taxes if you partake in one of the 4 taxable events that we talked about. So as long as you keep your money in the crypto sphere, you don't have to pay taxes. And I like to talk about Tether because it is an important component of making that happen. Now, Tether is a digital currency, and what it is, the company basically backs its currency with the US dollar. So you can actually go to them and buy Tether coins with your US dollars, and they'll give you 1 coin per US dollar, and that never changes. It never fluctuates. Let's scroll down here and read some of the description. Tether is a stable currency. Tether converts cash into digital currency to anchor or tether the value to the price of national currencies like the US dollar, the euro, and the yen. It is 100% backed. Every Tether is always backed 1-to-1 by traditional currency held in our reserves. So 1 Tether is always equivalent to 1 US dollar. So basically what this does is it enables you to take some risk off the table, right? So Bitcoin recently reached a high of $5,000, and there are some people that made a lot of money because of it. Maybe they bought back at $1,000 or $2,000, and now it gets all the way back up to $5,000. But I mean, that was a very crucial threshold, very, very crucial psychological threshold. And as soon as we reached it, we fell off a cliff, right? We dropped all the way down to $3,000. Now, a lot of us saw that coming, and we were able to sell off our position, realize some of those gains, and then buy back in at $3,000. That's what I did. I'm actually pretty proud of that. I've been streaming about it, and I predicted that pretty closely. But unfortunately, I wasn't smart about the way I went about it. I actually transferred my money back to Coinbase, sold it for US dollars, and now I'm going to have to realize those profits and pay taxes on them at the end of the year. So it kind of sucks. At the time that happened, I wasn't really familiar with Tether, but now that I am, here's what it is. You can basically do the same thing. You can convert your Bitcoin or whatever into Tether, and now you have a currency that takes all the risk off the table, right? So as Bitcoin falls in comparison to all the different fiat currencies, you're holding Tether, so you're holding US dollars. You don't have to worry about the price of all these other cryptocurrencies because you have Tether. Now, at any point in time, you can exchange it for US dollars. And there is a fee. Tether does charge a fee. It's small. It's like, I forget, 1% or something like that. But again, as long as you keep your money in the crypto space, there will be no taxes and no fees. So then, if you want to, once you think you predicted the low of Bitcoin or whatever currency you're trading in, if you want to go ahead and buy back in, now you can use your Tether to buy whatever cryptocurrency you want. And there were no fees involved. There were no taxes involved. Now you're right back into your Bitcoin, except you sold at 5,000 and you bought it at 3,000. So now you have so much more Bitcoin, so much more value stored there, and you did not have to pay taxes or fees for it. So Tether is pretty awesome for that. If you're wondering how to use it, I would recommend Bittrex. I use Bittrex. I'm actually logged into the account right now, and Bittrex has 3 primary markets, right? We'll talk about the Bitcoin market first off. The Bitcoin market allows you to use your Bitcoin to trade into any other altcoins, any other currencies. Whether you want to get into Neo, Quantum, Ethereum, ADEX, OmiSeguro, those are the top 5 traded currencies today. You can buy any of them using Bitcoin. The Ethereum market is the same thing. If you have Ethereum and you want to buy other coins, you can do it using Ethereum. And then finally, this is the USDT, or the USD Tether market. So this is where you use your Tether coin to buy Bitcoin, Neo, Ethereum, whatever you want to buy. You do it on Bittrex using the USD Tether market. So pretty awesome. Now let's talk about a couple of easy ways that you can ensure that you are IRS compliant as we approach tax season here. Really, there are 3 ways. First and foremost, you can maintain your own handwritten personal ledger of all the transactions that you make using cryptocurrency. This is the most difficult way by far, but it's also the most cost efficient. You're doing it yourself. The cost will be 0. So at the end of the year, you'll be able to use that information to pay your own taxes. Now, if you choose that route, then you're going to want to make sure that you record at least 2 things. You need to know the cost basis and the conversion price. So with cost basis, that just means you need to record the price that you bought the currency at, and then any fees or spreads associated with the purchase. And then when you go to compute it, the conversion price is just whatever price you sell Bitcoin at. So let's say you bought Bitcoin at $4,000 and there were $100 worth of fees associated with that purchase. So you're going to add 4,000 and 100 and get 4,100 and subtract that from 5,000. So the cost basis will be 4,100. Your conversion price is 5,000. 5,000 minus 4,100, 900. You made $900. And actually, I lied, because there's going to be more fees associated with selling the currency at 5,000 if you use Coinbase and you're not just simply converting it to Tether. So it'll be something more like 5,000 minus 4,200. You made $800 net, and then you'll have to pay taxes on that. So that's the first way that you can make sure that you're tracking your purchases throughout the year and being 100% compliant. The second way, and this is going to be a much easier way, is to use Dot Txt. This is their website that we're looking at right here, and it really simplifies the process. What it's going to do, it'll allow you to import all of your transactions throughout the year. And it depends on, so right now it works with Coinbase, Gemini, Circle, Bitstamp, Bitcoin Echo, Bitfinex, Kraken, and CSV. If you use any of those exchanges or wallets, you will be able to import your transaction history directly into Bitcoin Text, and then it will use its software to calculate your gains and income. So it saves you a massive headache there, and this is actually a pretty cool deal. And then step 3, you'll be able to file your tax return. Their software is compatible with TurboTax, so you'll just be able to transfer everything straight over to TurboTax, and it'll be easy. Filing taxes, I haven't used this before, but from what I've read, from what I've heard, it's very easy to file your taxes, including all of your crypto profits using Bitcoin Text. So, and then the final way to ensure that you are IRS compliant is to just seek out a CPA or a licensed professional. They will make sure that you are covered from every angle, and they'll basically file the tax return for you, or at least prepare it for you, And then if there's something wrong with it, it's not your fault. It's your CPA's fault, and that should keep you out from the front of the fire of the IRS. So that's how you can ensure that you are IRS compliant. Now, finally, let's look at when does the IRS actually file criminal charges, right? This is successtaxrelief.com. They have a pretty good article covering this, and basically I'm just going to read it, right? So when the IRS initiates contact with you over a serious matter, you should definitely take note and be prepared to respond, but don't panic. It is actually very rare for an individual to be investigated for tax fraud. Only about 2% of Americans are actually investigated, and only 20% of that are actually prosecuted. So if you do the math, the chances of you actually getting in trouble for this in the first place are very, very slim. But I don't recommend taking the gamble because it can really mess up your life if you do get caught red-handed doing tax fraud. So just make sure you're covered and pay your taxes. So basically, if they do start investigating you for tax fraud, the outcome is going to be one of two things. Either they're going to prosecute you for tax fraud, or they're going to be like, all right, you know what? You just made a mistake, and just pay us, just back pay us for all the taxes that you should have paid, and we'll call it a day, right? So tax fraud is basically just when you deliberately cheat on your tax return. The IRS does not take this lightly. Individuals who cheat on their taxes most often misrepresent their annual income and indicate that they received less in a year than they actually did. Tax fraud is defined as cheating on your tax return to avoid paying the entire amount due. You don't want to do that. You don't want to be caught up in tax fraud. That is a very, very bad idea. But like I said, probably won't have to worry about this because you probably won't be investigated. Just make sure that you're covered in the event that you are investigated. So that's it. That's pretty much it. We covered the 4 taxable events, right? If you receive Bitcoin for any tax, for any goods or services, you will have to pay taxes on that. Whether or not you liquidate that cryptocurrency into US dollars, you still have to pay taxes on it at the end of the year. Second, anytime you exchange Bitcoin for other property, whether you buy simple items or something bigger like a house or a car or something, that is a taxable event. You will have to realize those gains, if there are any, at the end of the year and pay taxes. If you're a miner and you generate Bitcoin by doing so, you have to pay taxes on the Bitcoin that you are awarded. And finally, if you are simply investing in cryptocurrency, maybe you buy Bitcoin, you sell it in the future, and you realize a gain, that is a taxable event, and you do have to pay tax at the end of the year. The only non-taxable event we talked about, and really the only one that exists, is by keeping your investment in the crypto space and just jumping between the different currencies. If you do that, you can continue to do that tax-free until you realize your profits in one of the four ways that we talked about. And then finally, we talked about the actual reality of taxes and how you can get into a lot of trouble with the IRS. The chances are against it, but you can get into a lot of trouble if you're not careful. Just make sure, like I said, you are paying your taxes. Now, Crypto Answers is not a licensed professional. We are not trained to help people pay their taxes or to understand this complicated system. So keep that in mind. I'm regurgitating all of the independent research that I have done over the past couple of days. And my intent obviously is to help you and get a very good idea of how to handle this mess yourself. But ultimately, it's a good idea to consult a professional, maybe a CPA, something like that, to just ensure that you are covered and not just take my word for it. Now, the only thing left to do is to say thank you for everyone who tuned into this video. I'm absolutely in love with the crypto community at this point. It's full of a lot of good people, and I want to do whatever I can to contribute and help you guys understand everything as it involves to blockchain and cryptocurrency, but especially taxes, because this is going to become more and more in focus, especially as we approach tax season and as Bitcoin becomes more and more well known and adopted. But at this point, I thought this topic was the most valid way for me to do that. So please, if you enjoyed this video or if you got something out of it, make sure you subscribe. That'll keep you in touch, in the loop. And anytime we upload any more news or information, you will be the first to know. If you want, leave us a comment. Let us know how we're doing. and then like the video if you did like it. Anyways, thank you guys so much for checking in. As always, I'm wishing you all good health and good fortune.